believe so. Let's get started. So a very good morning to everyone and welcome to this, our second Bank of England Watchers Conference. This is being jointly organised by the Qatar Centre for Global Banking and Finance at King's College London and the Money Macro Finance Society. My name is David Aikman. I'm the director of the Qatar Centre at King's, and it's my great pleasure to welcome everyone here today for the event. Now, we really set up this event to provide an independent forum to discuss and debate all aspects of Bank of England policy. First and foremost, we really want this to meet the demands of Bank of England watchers in the city, academia, and the media. But we also hope that, like its siblings in other countries, the Monetary Policy Forum in Chicago and the ECB and its watchers conference in Frankfurt, the discussion today will prove useful for policymakers at the bank, especially in these very trying times. We're doing this as an annual event. If you have feedback on what works, what you'd like to see different, or ideas for next year's events, please contact or speak with myself, Richard Barwell, or Paul Mizzen throughout the day, or you can email us afterwards. We'd be really grateful for your thoughts. And finally, a few bits of housekeeping before we actually kick off in earnest. So, firstly, be aware that we're filming today's event and we have a photographer present. So you kind of will be picked up on the recording unless you're sitting in the no film section. If you're not sure where that is, ask one of my colleagues. Secondly, we're not having any planned fire alarms today, so if the alarm does sound, we'll ask you to follow the fire exit signs, and there's an assembly point just outside of Somerset House. Again, you'll be directed there by our staff. Third, if you're happy to, we'd be really grateful if you engage with us on social media in this event and kind of give your views on the discussion today. We're using the hashtag BOEWatchers for that. And basically, any questions throughout the day, you'll see kind of members of our great events team from King's dotted around, and I think they're wearing red lanyards. So with that, let me hand over to Claire Jones from the Financial Times, who's going to chair the first session. Thank you.
Hi there, my name's Claire Jones. I'm the International Economy News Editor of the Financial Times, and it's a pleasure to be here today for the second edition of this great event. One of the biggest issues facing central banks here in the UK and elsewhere is what to do about their balance sheets, bloated by asset purchases under quantitative easing. There are, as rates stay higher for longer, questions about how big the balance sheet ought to remain, as well as more fundamental issues about what balance sheet policy ought to achieve, including its role in safeguarding financial stability. In answering these questions, we could not hope to have a better speaker than Andrew Hauser. Andrew is the bank's Executive Director for Markets, where he is responsible for, among other things, managing the bank's balance sheet, including all aspects of its design. Andrew, the floor is yours.
Well, thank you, David. Thank you, Claire. It's a great honour, actually, to open your conference today. And if someone could just put my slides up, if that's okay. Great. You've asked me to look ahead today, and I promise to do that. But some of you may have noticed an architectural theme in my title today. So let's start with a reassuring picture of the past. The Bank of England in 1902, the year of Edward VII's coronation. Swing the camera around at Bank Junction, and still 1902, and you can see this vista centred on the Mappin and Webb building at number 1 Poultry. Now hold that image in your mind for a moment. As Claire said, the central banks of today face many challenges, but 3 of the biggest are first, how to judge where our balance sheet should settle in the medium term as monetary policymakers return inflation, which remains far too high to target through higher interest rates and unwinding QE and other unconventional policy measures. Second, on the micro-prudential side, how to ensure that banks' liquidity insurance remains appropriate as technological change increases the risk of larger and faster deposit runs of the kind we saw in the US in the spring. And third, on the macro-prudential side, how to ensure the stability of the financial system as a whole in the face of the growing incidence of systemic liquidity shocks, not just from banks, but from non-banks as well. And those questions span the full width of the central banking remit, and their discussion therefore often involves different people with different goals, different analytical frameworks, and different policy tools. But there is one important common factor, and that's central bank reserves, the ultimate form of settlement, and hence the safest and most liquid of all financial assets. In most economies, including the UK, the stock of reserves has risen materially, Claire said bloated, over the past 15 years as a result of unconventional monetary easing. As that process reversed, the question is, what contribution should reserves make to those other parts of our remit, micro and macro-prudential stability? On one view, less is more. Generous reserve supply is argued to have exposed central banks to heightened risk, financial, operational, reputational, impaired market functioning, incentivizing inappropriate risk-taking in the private sector, amplifying rather than reducing some of the liquidity stresses we've seen in recent years. And while on that view that may have been a price worth paying when we were in a slump of nominal activity caused first by the great financial crisis and second by COVID, a very different future steady state is needed on this view, in which during normal times central banks return the supply of reserves to levels closer to those seen before the financial crisis, enough to lubricate payment systems, provide a modest buffer for unanticipated liquidity needs, but placing primary responsibility for managing liquidity risk on banks through private markets. Central banks will continue to stand ready to intervene in a genuinely cataclysmic system-wide stress, but this, on this view, is pretty much in the tail of the distribution. Now, this stripped-back vision, emphasizing a return to what's seen as central banks' core functions, has more than a little echo of the thinking of Ludwig Mies van der Rohe, the modernist architect who first popularized the phrase, less is more, and as some of you will know, designed this striking but sadly never built tower, which Peter Palumbo fought for many years to erect at number 1 Poultry. Let's call that stylized view the modernist view. In central banking, as in architecture, modernism is out of fashion, however, and as you know, Palumbo never won his fight to build that thing. Public authorities and market participants alike express real uncertainty about how far market mechanisms can be relied upon to help manage liquidity risk. Some note the limits that post-GFC structural vulnerabilities pose to the capacity of markets to provide ready liquidity in size and speed in a stress, and others go further, arguing that a key lesson of the crisis and more recent events, including the LDI events and the 2020 dash for cash, show that markets are stress amplifiers, particularly when there's a generalized shift in liquidity preference. On such views, central banks have a much larger role to play in helping to ensure effective system-wide liquidity management than they did pre-GFC, with the main debate being over how best to design that role. Some say central banks should ensure the system has ample reserves at all times, minimizing the need for firms to rely on marketable assets of unproven liquidity in a stress, maximizing their ability to meet runs in scale and speed. Others believe it may be possible to run with fewer reserves in calm times, but only if banks and increasingly non-banks too can call on a well-developed set of central bank liquidity facilities, allowing them to convert their assets into reserves in size and speed when they have to meet unexpected outflows. Now, returning to the architectural metaphor, this alternative, also highly stylized perspective echoes that of the postmodernists who saw modernism as excessively austere, underselling what architecture could achieve, and funnily enough, just a few hundred feet away from the bank, now stands one of the classics of British postmodernism, number 1 Poultry by James Sterling. They updated less is more to less is a bore. What does all this mean for us at the Bank of England? To cut to the chase, our head is postmodern, maintaining monetary control, micro and macro prudential stability in a world of structurally bigger and more volatile liquidity unavoidably, in our view, requires a much higher standing level of reserves than we supplied pre-GFC. But our heart is modernist, at least in parts, forged by a charter that seeks no larger a role in commerce than strictly necessary, and warmed by the thoughts of lower financial, operational, and reputational risks that being smaller could bring. The question is how far we can go to reconciling head and heart, and that's the subject of my remaining remarks today. Now, a bit of textbook stuff. At any point in time, the quantity and market price of reserves is determined by the interaction between demand and supply. Reserve supply is set exclusively by us, the central bank. Reserve demand, predominantly from banks, can be split into three classical motives: transactions, to meet known or predictable outflows; precautionary, to meet potential outflows in a stress; and speculative, capturing the idea that reserve demand will also depend on the rate of return relative to other liquid assets. Now, although the Bank of England has a range of ways to supply reserves, in recent years, by far the dominant driver has, of course, been unconventional monetary policy, and the lion's share of that reflected funding for QE via an overnight loan to our asset purchase facility. Most of the remainder financed term funding schemes such as the TFSME, and taken together, those schemes saw reserves, which are shown here in light blue, reach a peak of nearly 980 billion pounds at the start of 2022. That's equivalent to 40% of annual UK GDP, and more than 50 times the level in autumn 2006 that you can see over there on the left, when reserves were just 17 billion pounds. Similar increases have been seen across a wide range of other central banks, as I've shown here, but that process has now gone into reverse. In the UK, reserves are 170 billion pounds below their 2022 peak as QE unwinds, TFSME matures, and they're set to fall by another 110 billion pounds in the coming 12 months. Beyond that point, the future path for reserve supply implied by these operations is uncertain, depends on the MPC's future decisions and the extent of any voluntary TFSME repayments. But this chart shows two purely illustrative scenarios combining contractual TFSME maturities with a range of annual QT paces so far chosen by the MPC. But that is only half the story. To determine what happens next, we need to bring reserves supply and reserves demand together. So another bit of textbook here. This chart shows a stylized reserves demand curve for the system as a whole. If reserve supply lay below the sum of banks' transactions and precautionary demand, a concept that we call a bit of a mouthful, the preferred minimum range of reserves, or PMRR, there in the grey zone, banks will try to bid up for reserves, driving short-term market rates upwards. Conditions of reserve scarcity of that kind are shown here on the left-hand side of the figure. And when reserve supply amply exceeds the PMRR on the right-hand side of this chart, as it clearly has in recent years, banks' behaviour is determined by their speculative demand, and if reserves had a relatively low rate of return, banks would try to economise on those balances by lending them out or investing them in other liquid assets, driving short-term interest rates downwards. To avoid that, we remunerate reserves at the MPC's chosen policy rate, a bank rate, removing the incentive to economise. And this so-called floor system, introduced in the early stages of QE, has been highly effective in guiding market rates, as I've shown here. But as reserve supply falls back, we need to be alert to the fact that if we did nothing else, we're at some point going to go through the PMRR and hit that upward sloping part of the demand curve, potentially losing monetary control. Determining where the PMRR might lie requires unpacking those transactions and precautionary demand that I talked about earlier, and those in turn are affected by two things: the size of liquidity claims on banks, in particular deposits, and banks' liquidity preference per unit of liquidity claim. Both of those have risen significantly since the GFC. There are currently £3.2 trillion of sterling sight and time deposits held at banks that are members of the Bank of England's Sterling Monetary Framework, or SMF. That's nearly 50% higher than mid-2006, shown here in white. And within that, sight deposits, which are obviously the easiest to withdraw and therefore a key source of short-term liquidity risk, are currently 2.1 trillion. That's the yellow-green line there. One proxy for banks' reserves demand to cover the transactions motive is their need for ready cash to meet payments flows. And if you add together the amount required to meet daily pre-funding requirements in retail payment systems, about 40 billion, the average daily liquidity required to settle high-value payments, another 40 billion, and average settlement balances for other payment and settlement systems, let's call that 20 billion, you get a number like 100 billion. So far, so modest then, particularly when compared to current reserve levels. But banks' precautionary demand is likely to be much bigger. A central lesson of the GFC was that banks held too few liquid assets voluntarily to manage their stresses that they faced. And in response, banks, as you well know, have since 2013 been required to hold sufficient liquidity buffers to cover 30 days of modelled stress outflows, calculated by applying a set of weights representing a particular scenario. And the sum of those so-called liquidity coverage ratio, or LCR requirements across SMF banks' sterling deposit liabilities currently amounts to about 570 billion. That's shown in the yellow gold line there. Now, that is a big number, and if the PMRR were that big, we could be there quite soon. But there are many uncertainties. The LCR is only one way of assessing how much bank stress liquidity needs could be, and the future steady-state PMRR is likely to differ from today's aggregate LCR for several reasons. Some point to a lower number. Banks can obviously hold assets other than reserves to meet the LCR. Some interesting lack of labels there, sorry about that. I'll try and fill those in. First, banks can hold assets other than reserves to meet the LCR, as I've said. The list of other eligible high-quality liquid assets, also called HQLA, includes government bonds, multilateral development bank paper, and at appropriate haircuts, corporate debt, covered bonds, and even equity. And in practice, such assets form only a very small part of SMF banks' sterling liquid asset buffers today. If you could see the labels, you'd know that they were the purple and orange bits on the top there. The rest of that big column, which is their liquidity holdings, is quite fun actually, I could have done this with all the slides, are reserves, those reserves that we put into the system. The right-hand side blob is the blob that I already showed you on the table, which is those modelled outflows in the LCR. The 30 days is the purple, of which the first day outflows, potentially first day outflows in terms of contractual liabilities, is the shaded bit. That's unsurprising, that shape of that distribution of liquid assets, given how many reserves we put into the system. But as QT progresses, banks' preferred holdings of non-reserves HQLA will depend, amongst other things, on how many HQLA assets there are, what their relative rates of risk and return are, regulatory rules, and importantly, reserves are exempt from banks' leverage ratio calculations in the UK, so they are attractive to banks, and perceived ease of monetization in a stress. And let me come back to those points in a minute. Second, bank deposits, which, as I said, are a key driver of transactions and precautionary demand, are going to decline as monetary accommodation is withdrawn and QE unwinds. The scale of that effect, not clear. Vera Liccaria and Raghu Rajan and their co-authors have recently noted that there was no material decline in the US deposits when the Federal Reserve first tried QT. And you can see that in that grey zone there in 2018, 2019. But deposits have started to fall in both the UK and the US, as you can see here, during the current tightening cycle. So it does seem likely that QT will bring deposits down. Third, higher longer-term interest rates are driving a shift from sight to time deposits, which obviously have lower outflow rates as depositors seek higher returns and banks bid up for funding. And in the UK, the ratio of sight to total deposits has already fallen from 70 to 64% and could fall a lot further if it was going to hit the 40 to 50% range pre-QE. So those are all factors that may bring the PMRR down over time. Some others push up on it. In particular, we know that banks want to hold further liquidity buffers above their LCR requirements. That might be to capture liquidity risks that they judge aren't fully captured by the LCR. This chart shows the pace and scale of some of those recent distressed events in the US and elsewhere, and the number of days that the flows took on the x-axis and the outflow rate on the y-axis. And you can see there those LCR weights in orange. You can see that a number of those events, you knew this already, but the numbers I think are quite striking, involved runs that were both materially faster or larger than those assumed in the LCR. Banks may obviously also want to hold additional buffers to signal their financial resilience, but while the supply of reserves is as large as it is, we can't really know where banks' true desired buffers lie. That'll only become clearer as QT proceeds. Now, one obvious way to get a handle on banks' PMRRs is just to ask them. And we do that twice a year with a survey. And the latest aggregate PMRR estimate that we got from that exercise was 335 to 495 billion. Sounds quite perhaps spuriously accurate, but those are the numbers we got from the survey. That's a bit lower than most of the numbers in that table, but it's still big. And what I've done here is I've converted it into an estimate for the size of our balance sheet in that green swathe and compared it to a very long run of data that we have for the Bank of England going all the way back to 1700. And you can see that if reserves did settle in that range, that the balance sheet of the Bank of England would be as large as it has been at any time in history, including the South Sea Bubble and World War II. Combine that with those illustrative profiles for reserve supply falling down that I showed a minute ago, and we could get there in as little as 2 or 3 years, maybe even earlier. But we need to pause again at this point, because PMRR estimates of the kind I've talked about have another key limitation when considering optimal balance sheet size, and that's that there's no actual reason to assume that the sum of individual banks' reserve demand should necessarily be the same as the level of reserves we need to sustain stability in the system as a whole. And to see how that potential fallacy of composition comes about, we need to return to those big numbers in that table I showed you a minute ago. Now, those aggregated firm-level outflows can only be outflows for the banking system as a whole if they're all transferred into banknotes or some other external payments medium. But that isn't how most bank runs work, of course. Depositors that become suspicious of Bank A tend to transfer their funds to Bank B. That means that one bank's outflow is usually another bank's inflow, and that's always true of reserves because they can, by definition, only be used by one bank to pay another. So to the extent that the system can provide the right infrastructure and incentives to recycle reserves from surplus to deficit banks, the stock of reserves required to meet banks' net transactions and precautionary demand can be much lower than the sum of their gross needs. And supplying over only a fraction of banks' gross needs could mean a smaller steady-state central bank balance sheet, and that appeals to all of us with modernist hearts. One way to recycle reserves is by a financial market. Government bonds and other forms of non-reserves HQLA can be highly effective ways for banks to meet unanticipated outflows to the extent they can be converted into cash quickly and in scale. Daily volumes in cash gilts, which I've shown here, have ranged from 30 billion in normal conditions to a maximum of 100 billion in extremis, and overnight gilt repo 60 to 90 billion. So that's big enough to meet a range of firm-specific outflows, and firms can hold non-UK HQLA too, like US Treasuries, which further expands the potential asset pool. So take that together, and that suggests there's certainly some room for banks to hold more of their liquidity buffers in non-reserves HQLA as the supply of reserves falls, a process that will, to some extent, happen naturally, and to some extent could be incentivized by central banks if they wish to do so. But the extent of any such adjustment will need careful testing. Extended settlement periods and hedging and leverage ratio costs make non-reserves HQLA imperfect substitutes for reserves as liquid assets. And the dash for cash and the LDI crisis and other recent events globally have posed questions about the structural resilience of those markets in a stress. Sterling market depth is clearly nothing like the size of those hundreds of billions numbers in the table either. And so it's possible that some of these constraints may ease over time as programs to strengthen the non-bank financial intermediary or NBFI resilience, core market infrastructure and central bank toolkits make progress and QT returns more collateral. But in current circumstances, there clearly are limits to the extent that banks can rely on private markets to monetize non-reserves HQLA in a stress. But there is another way for banks to monetize their assets, and that's by using central bank liquidity facilities. And huge advances have been made in this area since the GFC. As this chart also shows on the top, UK banks have built up the capacity to borrow nearly £500 billion of reserves from the Bank of England against a range of pre-positioned, mostly less liquid collateral. And they can borrow a great deal more than this against more liquid collateral, including HQLA, if the underlying markets freeze. That collateral can be used across almost all of our lending facilities, including the weekly index-linked term repo facility, the discount window facility, the contingent term repo facility. We are definitively, as our previous governor put it, open for business. On the face of it, an aggregate borrowing capacity of £500 billion at the top there is enough to meet most of those outflows in the table. So shouldn't we be considering a radically different setup in which the stock of reserves is relatively small in normal times but expands rapidly and at scale when needed via usage of these facilities? Well, there are three main reasons to that not being a complete answer. The first is that although that total number looks big, while many banks have strong pre-positioning and test usage regularly, some don't yet have much drawing capacity for various reasons, and you saw that actually with SVB in the US in the spring. So liquidity facilities aren't yet a universal solution. Second, banks' ability or willingness to draw from our facilities at scale and speed is a bit unproven. Where the constraints to that drawing are technological, they can surely be fixed over time, given enough resource. But some banks still worry that investors, depositors, or even supervisors see facility usage as stigmatizing, amplifying rather than mitigating stability concerns. Now, we've made progress in reducing that risk in recent years, including through the development of market-wide facilities that banks perceive to be safer to use, the issuance of supervisory guidance stressing that the use of central bank facilities is part of normal liquidity management. That's a message to supervisors as much as to the market, and balanced disclosure regimes. But stigma is hard to get rid of altogether, and firms that, for any reason, balk quickly from drawing quickly and in size from the central bank when a liquidity shock hits and lack alternative sources of liquidity, which again is what happened to SVB, are exposing themselves and the system to risk. Third, banks can only count access to their facilities towards their LCR requirements as and when they actually draw them down, adding to their reserves holdings. So that means that although there are many positive arguments for having such access, it doesn't help them to make that choice between holding reserves, however they might be supplied, or other forms of HQLA to meet that LCR requirement that they're supposed to hit at all times. So where does that leave us on those big questions I posed at the start? The marked tightening in post-GFC bank liquidity requirements and the continued growth in the size, speed, and breadth of liquidity shocks since then has increased the precautionary demand for reserves. The kink in that reserves demand curve in figure 4 has moved decisively to the right. Against that backdrop, maintaining monetary control, micro and macro prudential stability means supplying many more reserves than we did pre-2008, when, as you saw in the second chart I showed you, the Bank of England lay near the bottom of the global distribution. To that extent, we're resolutely postmodernist. But we can give succor to our modernist hearts in three ways. First, while we know the reserves demand curve has moved to the right, we don't know exactly where it sits. And while we can't afford to lose monetary control by sort of crashing into that upwards part of the curve unexpectedly, it doesn't mean we have to supply an unnecessarily excessive level of reserves. So we will use our toolkit to test where the true aggregate PMRR lies as QE and TFSME unwind. I quite like the music. That's creating a sense of, I'm not sure, is that telling me to get the hell off the stage, Claire? Or you got a clicker somewhere? It'll grow slowly as I reach my conclusions. But hope it doesn't actually. But while we, where the hell did I get to? So we'll use our toolkit to test where the true aggregate PMRR lies, sort of party political broadcast, as QE and TFSME unwind. To achieve that, we introduced last autumn a weekly market-wide short-term repo facility, or so-called STR, offering unlimited amounts of reserves against gilt collateral at bank rate. The STR is designed to pick up emerging scarcity and reserve supply at an early stage, replacing reserves drained through QT or TFSME, which will continue until the MPC wants them to stop. That will allow the MPC to continue to make independent decisions, focused solely on achieving the inflation target without having regard to issues of the kind that I've talked about today, including the shape of the bank's balance sheet or the potential for the loss of monetary control, which is, the job of the executive, not of policymakers. Second, we'll continue to work with others to deepen alternative liquidity sources. Part of that means continuing to ensure that banks have gone further and further to being ready to use our contingent liquidity sources at facilities and size and at speed, broadening and deepening the stock of pre-positioned collateral, ensuring firms test regularly and working with them to tackle residual stigma concerns. The readier banks are to use those facilities, the fewer excess reserves they should feel the need to hold in normal times, pushing that demand curve to the left. The same is true of efforts to ensure that core HQLA markets can function in a stress, including through strengthened non-bank resilience, helping others to improve market infrastructure and building effective central bank backstops. Third, as that work progresses, and some of it, frankly, will take years, we can continue to explore how our toolkit might be calibrated to return market incentives and disciplines more centrally to firms' liquidity management. It will be a brave central bank that places much faith in those mechanisms as we did pre-GFC, but that doesn't and shouldn't mean usurping them altogether, not least because doing so risks amplifying rather than reducing risks to financial stability, as well as incurring financial, operational, and reputational risks ourselves from being unnecessarily big. Price incentives are one tool. We could, for example, reduce reserves demand in steady state by increasing the price at which we supply replacement liquidity as QE and TFSME unwinds. But there are real limits to how far we can go in that direction without destabilizing monetary control, hitting that kink. Central banks also have non-price levers that could influence reserves demand, but judgments on setting those are quite complex, and we need to make them in ways that didn't take risks with monetary control, micro or macro-prudential stability. So while one day less may be more, for the time being, I'm afraid that less is a bore. Thank you, and I look forward to our discussions, Claire, today. You killed the music as well, that was good.
So thanks a lot for a very thought-provoking speech, Andrew. Just to say, we very much like to take questions from the audience. I'm just going to use my chair's privilege to just ask you one now before turning to you guys. So I think what I liked about this speech is, you got a sense of your mindset but while still acknowledging there were an awful lot of kind of like known unknowns. To what degree is there also unknown unknowns in the shape of shadow banking activity, and how do you really take account of that in terms of balance sheet design in the coming decades?
So a lot of what we're talking about today here is about banks, and we need to remember that the financial system still relies heavily on banks. Even during the crisis of Dash for Cash, even the LDI crisis, banks played an important role in getting liquidity to the wider system. So, and I guess actually, frankly, the events of this spring with SVB and Credit Suisse reminded people, if we needed reminding, that just because non-banks are a bigger deal now than they were in the past, it doesn't mean the banks have gone away and that they don't pose risk. So a lot of this is about ensuring that banks have the liquidity to do their job of providing liquidity to the wider system. And in many cases, that's enough. That would always be our first step. As you say, Claire, and I've talked quite a lot about this, and others have too, and I know Tobias, who's here from the IMF, has done quite a bit of work on this as well. The source of liquidity risk in the system is much wider now than it was before, and in particular, this isn't news really, right? A lot of people talking about this pre the global financial crisis, let alone now. Liquidity risk can come from non-banks and financial markets as well. The main way to deal with that is obviously not central banks, it's to ensure that the people in those markets have appropriate self-insurance and appropriate resilience to deal with the risks that they are posing, and that's work that has further to go, I think it's fair to say. But as you say, central banks can't ignore risks that come out of the non-banking system if they arise. I think it's interesting to think about how those risks are different to the risks that arise in the banking system. Banks provide liquidity. Non-banks don't provide liquidity in the same way. They engage in markets and they engage in market liquidity. And our job in ensuring that non-banks can continue to trade is to ensure that those markets have what you might call market liquidity. We did that in the LDI crisis by buying goods temporarily and then selling them back. Central banks did that in 2020 during the Dash for Cash as well. That may mean temporarily injecting reserves into the system, but it will also mean removing them when those markets are functioning again. So I think what we're talking about here is definitely part and parcel of dealing with liquidity risks in banks and non-banks, and I would see the main toolkit for dealing with non-bank risks when they arise, hopefully they don't arise very often, would be those contingent liquidity facilities. We did buy sell operation last autumn. We'd rather not do that if we could avoid it given the risks involved. That's what a few weeks ago I talked about developing lending facilities for non-banks as well.
Can I now turn to the audience, please? Can I see a show of hands, and we'll maybe take 3 questions at a time. So if we...
Kind of hard to see.
Yeah, it's not... Is it possible to get a little bit more light? Excellent, thank you. So I see 2 hands raised here. So if we have the woman first and then the colleague next to you, that would be great. And then if we go to this guy here in the first row after that, that would be fantastic.
All right, thanks. Patra Tarazza, University of Cambridge. Greatly enjoyed your talk. So I was wondering, when the Federal Reserve engaged in quantitative tightening before the pandemic, Janet Yellen, then still chair, said that this process of quantitative tightening was going to be as boring as watching paint dry, until suddenly it wasn't in September 2019, when there was turmoil in repo markets and the Fed had to scramble to resume its large-scale asset purchases. How confident is the bank that it will be able to avoid a similar episode, which obviously would put the bank in great difficulty considering the current high levels of inflation? And as my second question is, to what extent is the speed of quantitative tightening determined by monetary policy considerations? Does the Bank of England think that the increase in the speed of quantitative tightening that it has decided helps to tighten monetary policy conditions and reduce inflationary pressures? Thank you.
Thank you. Kaya Özyürek from the University of Cambridge. Given the repo market stress in the United States in 2019, it may also seem necessary for the Bank of England to have in place a permanent non-bank financial institution lending facility. My question is, do you think if the Bank of England were to have a permanent lending facility for non-bank financial institutions, would that exacerbate risk-taking in the form of higher leverage? And how would Bank of England mitigate that? Thank you.
Brunello Rosa, Rosen Rubini. Hi, Andrew. A question. One of the projects the Bank of England is undertaking is, of course, on central bank digital currencies, let's call it the digital pound. I wonder if you could explain how the potential introduction of a CBDC would impact the Bank of England balance sheet going forward. Thank you.
Do you want your pen back? We've only got 1 pen. It was my fault, not Claire's, but sorry about that. I'm glad I did write the questions down. Exactly, we can share it. So Petra's questions first. Yeah, I don't know whether that comment about QT being like watching paint dry is probably one that public policymakers regret making, because it dried rather quickly, didn't it, that comment? I think, and I talked about it briefly, actually, I talked about it briefly, the experience of the Fed in 2019 was an important wake-up call for them and for central banks generally. And sort of let's remember what happened there. They had a survey, a bit like ours, that I think they probably placed quite a lot of faith in terms of judging, well, where would we, they didn't call it PMRR, they called it the LCLOR or some incredibly long acronym. We should do better on acronyms. But I think they thought they knew within a range where it was. And obviously as reserves came down, they hit trouble much sooner. And short-term rates bounced upwards. And they effectively lost monetary control for a period, not very long, but long enough to cause them to review whether QT was a good idea. You know all that, but it's probably worth just reminding people of that. For us, what I think that underscored, I think we probably had already realized this, but it certainly underscored for us, is the importance of recognizing you've got no idea where this PMRR is. You don't know where it is today, and you don't know where it's going tomorrow. So you have to design your interventions in a way that are robust to that uncertainty. Because if you think, well, we're fine, we're not fine, as you say, it causes policies like QT to have to stop, which is I mean, just really, I mean, from an executive perspective, it's not something that policymakers welcome. Let's just put it like that. That's why we put in place, and it does actually answer your colleague's question to some extent, a repo facility where we offer unlimited amounts of reserves on a weekly basis at bank rate, so a zero corridor. I'm told not to use that phrase, but I'll use it here as long as you don't repeat it, in order to ensure that at the point banks and others find that they need reserves because they're being drained by QT, they can come and get reserves from us. Now, will that be a perfect solution? Because there may be sigma, there may be other balance sheet costs that make it slightly harder for them to want to borrow at bank rate. There may effectively be a corridor that's not zero. We don't know. But certainly we would expect and hope that that tool would begin to pick up providing reserves as and when we hit the early stages. I often think of it as being like a sort of spaceship coming in from outer space and hitting the outside of the atmosphere, as and when we begin to hit that range. At that point, we clearly will have to think, well, do we have the right tools in place to ensure that we can continue to maintain monetary control? And we may have to add to them or change them in some ways. But we have what we hope will be an effective early warning system precisely put in place to design to avoid that situation. Am I confident it will work? I mean, I should never say yes, but we certainly have designed it with that in mind. Your second question was about the speed of QT and whether it was sort of determined exclusively by monetary policy considerations. I mean, I think my first answer is yes, because it's the MPC in the UK that is exclusively decides upon QT pace. We may advise them about various things to do with market functioning, but the decision is entirely for the MPC, and I think that's true in the Fed, and it'll be true in the ECB and elsewhere as well. That's important because it was a monetary tool on the way in, and even though estimates, as you know probably better than I do, of QT multipliers are probably quite small. I mean, I think the market puts it about 10 basis points, which is, you may say, neither here nor there, though no one knows. It's still not zero, and therefore there's an important governance point that it should be decided by the MPC and should be stopped by the MPC when they choose to do so as well. We do, however, advise them about the range of paces that we believe would be consistent with continued market functioning. And that's a key criterion for them. They have three criteria. One is that bank rate should be the primary tool. Secondly, that whatever they do should be gradual and predictable. That's the new boring version of paint dry. And third is that they shouldn't create destabilized financial conditions. It's that third test that we advise them on, and we do that jointly with the Debt Management Office and others, assessing the capacity of the market to take sales and redemptions, and they choose then within that range. There are some non-monetary implications of pace as well, right? I mean, the quicker you can get collateral back into the market, the quicker you can reduce swap spreads and reduce special spreads in repo markets and so on and so forth, the quicker you can rebuild headroom should you ever need to use QE again. So there are a bunch of other reasons that I think favor getting on with QT where you can, and I think those are shared. But we're certainly not going as quickly as some in the market, as some globally, and we're not going as slowly as some as well. Your colleague's question was about NBFI facility. Well, of course, we are developing an NBFI liquidity facility. We already have a complete set of banking facilities, and I announced a few weeks ago that we were doing that. Your question was, might that be an own goal? Because in doing so, we actually give people new opportunities to take leverage and to pose risks rather than reduce risks. It's definitely in our minds. That issue is definitely in our minds. I think it applies to any facility that you might put in place, right? Budget pricing. You want to set it at a place where people do not find it attractive to use your facilities just to do a leverage trade or to trade in and out of markets or arbitrage them in normal times. Equally, if you price it too aggressively, no one's ever going to use it. You're going to have the financial stability problems that you think about. Our view is that you can solve that problem. You can find a set of pricing and haircuts and other design features that navigate that narrow path between the two risks you describe. But it's definitely a technical challenge, and there's definitely the risk that you describe is definitely one risk. The risk of creating financial instability is obviously there on the other side. So classic central banking. Maybe we'll do it well, maybe we won't. But you're very right to raise that question. Bruno raises CBDC. Thanks for that one. I should probably remind you that we're consulting on the merits and demerits of a retail CBDC. We haven't made any decisions on that, and I think most central banks are probably taking years rather than months and weeks on that question. It's a nuanced one and doesn't just involve central bank decisions, it's a government issue as well, clearly. How would it impact the Bank of England balance sheet? I could give you a boring answer and say I've done a speech on that in the past. It clearly would be a new liability for the central bank. And so it clearly would, other things equal, kind of, be elbowing out other liabilities that might sit on our balance sheet. If it looked a bit like banknotes, and it was, 80 billion in a 1 trillion balance sheet, I'm not going to get too excited about that problem. It can be accommodated. Banks would have to come and swap their normal reserves for CBDC, which is probably rather similar to reserves to them, and we'd probably go on as normal. If it were a much more aggressive type of concept in which, it was a wholesale CBDC, perhaps remunerated, perhaps provided to a wide range of people in the economy, it could become a very large part of that balance sheet. And at that point, one would have to think much more carefully, I think, about how you integrated it into monetary control regimes, financial stability regimes, et cetera, et cetera. Right now, the direction of travel in the UK is much closer to the former than the latter, so something that we're very closely involved with, something we take a great deal of interest in, but I think it will be one more liability to manage on the balance sheet rather than something that would fundamentally change the way we thought about our big challenges.
Just returning to your responses to the first set of questions on QT, I think it's one that the issue that interests me is one of optics. What happens to the QT policy if this doesn't look like something that the Bank of England will do very soon based on yesterday's press conference, but it doesn't look like we're going to get rate cuts in the UK very soon, but certainly in the US we could perhaps see rate cuts next year. How would you deal with the optics and the communications challenge of doing QT at a time where you're loosening the main tool of monetary policy?
I mean, I think, and I go back to Petra's example again of the sort of phase 1 QT, it's always good to have a central bank other than you going first because you can learn from them. Obviously, one of the learning points, and the Fed have been very open about this at that period, was that in retrospect they probably didn't differentiate enough market understanding of how rates and QT were thought of as policy instruments. And I think what we've all done since then is we've been much clearer that the primary tool is bank rate and that QT should happen in the background. And as Petra said, I mean, how far in the background can we do it is a technical challenge. But so far, I think actually we probably have, in the UK and the US, managed to pull off QT operating in the background. And so the marginal tool that the MPC will use to affect inflation is bank rate. Bank rates, better or worse, a lot higher than it was now, and it's not going to hit the zero nominal bound anytime soon. So to the extent that there is nothing, I mean, what I'm saying is there is nothing intrinsic in the way that we have set things up that says QT must stop when bank rate starts to fall, if bank rate starts to fall. Bank rate is the primary tool. Dave Ramsden's actually already said in a speech, I think, or an interview with Reuters last year, that he doesn't see any necessary connection between the two. The MPC, though, will make that decision on a year-by-year basis. The Fed, in their minutes in July, also said that a number of their members recognised that it could be quite possible, I guess this was maybe because it was felt that the US rates might be moving sooner than the UK at that time, that it was perfectly logically possible to continue QT. Let's think about what would happen if you didn't even allow that possibility. 1 trillion of reserves, 1 trillion of QE, we've taken a bit of it off. Is that going to be stuck there for good? Are we going to be there for good? So I think you have to challenge yourself as to whether that can continue or not. But it's for the MPC to decide, not me.
Did you have another show of hands? So David, if we give the mic to you first, and then these two gentlemen here. Great.
Yes, thank you. David Marsh from OMFIF. My question is about AI, which is very much in the news lately. But before that...
Of course it is, David.
I thought it was very apposite that you spoke about the spaceships, because, of course, if the spaceship comes in too quickly, then the first thing you notice is that paint, you've spoken a bit about paint, it starts to blister, and then the whole spaceship burns up. So that is really quite salutary to think about that. Regarding AI, because of all that you've said, we can see there's a lot of reserves in the system. It's all a bit volatile. Things will go up, things will go down, geopolitics comes into it. I imagine there's all sorts of boffins out there with all kinds of instruments on AI, kind of plot what you think you're doing and to try to reproduce it. Do you have a team of people at the Bank of England, team of well-paid young boffins all padding around in sneakers who are trying to reproduce the systems that other people are setting up to try to track what you're doing?
Thank you. Mario Pisani, I'm a visiting professor here at King's College London, among other things. Thank you, Andrew, for a wonderful speech. I wonder whether you could tell us about what you think your vision of the balance sheet means for the future of the explicit Treasury indemnity on the majority of the balance sheet. Because you could, some people could argue that if the majority of the reserves on the balance sheet are there for stand-in facilities rather than temporary interventions, the need for an explicit indemnity is reduced. And similarly, the amount of financial risk that you take on through liquidity insurance is lower than through quantitative easing. Thank you.
Thomas Villar come from T. Rowe Price. Thanks for a great speech. So we know that governments are going to be issuing lots and lots of debt. And with QT, the private sector will have to take up more and more of the debt. So in other words, there'll be a glut of other HQLA assets, which are a great substitute for reserves. So isn't there a risk or a chance that actually the balance sheet will end up at a much lower level than we've seen in your projections because of that, just because there's lots of other substitutes? And I guess, how would that affect your analysis?
Shall I take? Why don't I take that one? I'll take that one. I'll take that one last. Normally, people. I thought you asked me a different. I almost went to auto, response on a different question, which is, aren't you mucking up gilt markets by doing QT? But I won't answer that question because you didn't answer it. You didn't ask it. I'll have to stop myself. I think if I understand your question correctly, it was that actually, with governments issuing HQLA and us returning it, far from the sort of very pessimistic predictions that maybe I had in my speech about God, where is anyone going to want to hold this? That actually maybe the market will be flooded with it, and that lots of people will hold it. Is that right? Is that what you were saying? I mean, that would be a nice problem to have. Is my honest and simple answer. I think it would be very nice to get to a place where the LCR arrangements were working. In the way perhaps that the people who wrote them originally had intended, which is that banks primarily would stand on their own 2 feet in normal times, would use liquid assets that they could liquidate clearly and easily and at market clearing prices in normal times to meet unexpected outflows of normal, not exceptional kinds. I'd be very happy, I think, and I think a lot of us would be, if that were the world we found ourselves in. I don't know that the kind of data I've suggested here today in terms of market depth and questions, I don't know if you were to get the average bank treasurer in the room, and there may be some in here, I don't know, that they would think that's the most likely outcome. But if it did happen, perhaps we should stay in touch. I'd be very pleased, frankly. Mario's question about the indemnity. Mario presented himself as a professor, which he is, but he's also a Treasury official. So nice one, Mario. You're obviously on a it's bonus time. So obviously on a remit. What is the future for the Treasury indemnity? And of course, actually, the UK arrangements are unusual, right? I think, are they unique? Certainly very unusual globally, in the sense that very early on in this arrangement, Mervyn King at the time, the governor, said, look, I think we should put the assets that were purchased for QE in a separate vehicle. Government should indemnify them. The purpose being that the MPC could have exclusive focus on monetary outcomes and not on the potential for there being a fiscal monetary margin. That worked very well, certainly for a period. Everyone thought that, I remember writing the letter, it may have been with you, Mario, about, we're going to leave in 2010 or whenever, we're going to unwind QE in 2010, and that would be that. That feels like a long time ago. But and your question was, well, look, could we imagine a world in which the APF, I think, if I put it in my words, would run down more or less to zero, and the Bank of England is standing on its own 2 feet again and is funding its own operations, reserve supply on its own capital? That is exactly my personal first best, if I'm totally honest with you, from a balance sheet management perspective, the APF was a temporary product. It came, it got very large, it went away. As we've discussed, and we already had some questions, that's in the question whether the APF runs down to zeros for the MPC. It has to judge that in terms of monetary policy. But a world in which the APF, whether it exists formally, logically, or legally, or not, has run down, and the Bank of England is again doing its normal operations without it, would be in many ways a very good and nice outcome. It's many years away, and relies on a whole bunch of decisions, including by the MPC, that haven't been made yet. But I mean, that would certainly be a possible outcome. I mean, David's question on AI, I don't know where to start. The boffins in, it's just quite funny if I use the word boffins to the average, what you would call boffin, David, now they wouldn't know the word. It's a kind but we are, I mean, central bankers, they're always quite late, right, to these things. And it's quite funny watching a bunch of central bankers in a room being presented to about AI. They sort of, loosen their tie and try and look a bit more sort of thick of it for an hour or two. But central bankers are definitely learning about the ways in which AI can be deployed by central banks. I mean, we've used earlier generations of that technology and things like processing large amounts of supervisory material or high frequency foreign exchange data for some years, but certainly central banks are trying to get their head around what AI might mean both for economies and for their own operations. I think the kind of world you describe where the markets are using AI and then we're trying to use AI to understand them, and there's a risk of a kind of infinite regress there, right, of machines trying to understand machines, and sooner or later I guess they'll all blow up. So I wouldn't paint a picture of that particular kind of iterative process going on all that much. There are still a lot of people at the end of phones to speak to as well. But certainly the trend is that way, and we're trying to get our head around it.
In the front, and then to Francis, and then,
Thanks a lot, Andrew. I wondered if I could ask a question about the broader implications of QT throughout the financial market. And what I'm thinking here is, as we move to QE and lower for long, we talked a lot about search for yield, and how investors, not getting those returns from bond yields move to riskier and riskier assets. So my question really is, what is the opposite of search for yield? What are the broader implications of QT for the financial system? 10 basis points that you mentioned sounds very sanguine. And obviously, the market chatter recently has focused on how QT is influencing the interest rate term premia. Thank you.
Francis Coppola comment. As I understand it, what you're proposing is, or what you're doing, is encouraging banks to move away from holding reserves on a prudential basis towards holding a range of other safe assets on a prudential basis. One of the things I noted from the SVB debacle earlier this year was the way in which the market price of safe collateral fell, and that interfered with SVB's ability to raise the funds it needed in a bank run of that size. So I'm wondering whether your thinking includes measures to deal with the risk that the increased reliance on safe collateral introduces to the liquidity system.
Thanks a lot, Francis, and then the gentleman here.
Thank you. Toby Nangle. A very quick, probably yes or no question, which is that I understood from the speech and your answer to Maria's question that you've got a desire to return to a framework in which reserves are specifically unremunerated. I just wanted to clarify whether that inference is correct. Thanks.
Let me do a reverse order. No, wrong conclusion. The basis of our regime is reserves remuneration, as I talked about in the floor diagram. If we didn't remunerate reserves, rates would fall below bank rate, and at a time when we're trying to bring inflation down, that would be uncomfortable. So the core of our system at the moment is reserves remuneration. Francis' question, I mean, you put your finger on it, Francis, about the issue on HQLA, and just to, I know it's reassure, but just to clarify, what I was trying to say, perhaps poorly, is that we have almost a corner solution at the moment where almost all of banks' liquid holdings are reserves. I mean, that's by construction, and it is what it is. But it does have implications for the size of our balance sheet and wider things. I'll come to Jemana's question in a minute. That's not neutral, right? So what I was trying to say is it does strike me as that there is scope to rebalance somewhat and to get to a place where banks hold a larger share of their liquid assets in HQLA. It's almost an adding up constraint requirement that should happen. But the risk you describe, I didn't remember that SVB caused a major wobble in US Treasury markets, but you're absolutely right that happens, and it could happen much more seriously, is exactly why I start from the perspective of being somewhat pessimistic about the extent to which that shift towards HQLA can occur. And that's certainly what you hear from banks and financial institutions as reserves come down. Oh my God, we're going to have to hold those things, and we don't know if we can liquidate them. I was encouraging people not to think of that as being a complete doctrine of despair. I mean, it isn't. Actually, a lot of these markets trade pretty well a lot of the time. They're big, liquid, and deep. They may not be as big liquid and deep as they were 20 years ago, but they're hardly dysfunctional in normal times. But the precise risks that you describe, that they may be less than perfect sources of liquidity. I mean, you could have mentioned other things too, right? I mean, gilts settle a day later, so you don't get cash now. They have leverage ratio implications, which we may need to reflect on. They are not by any means perfect substitutes for reserves. The question for us, I think, and for all central banks is, do we simply flood the market with reserves, even if it has costs for us, or do we try to rebalance somewhat? But the risk you describe is absolutely real. One of the reasons why we obviously are building and have built some backstops is to try to deal with extreme events that might cause that. I don't think we would have come in an SVB type context. I don't think the Fed was, the Fed had other interventions, clearly, but the interventions they had were not primarily focused on the US Treasury market functioning. They were focused on dealing with the underlying issue in banks. But yeah, I mean, the depth of those markets is unproven, and it actually links very neatly, I think, to Jemana's question, which is, I think my first point I'd say, because I have to, because I'm paid this, Jemana, is that actually parts of QE have clearly impaired market functioning. It's often talked about as QT is impairing market functioning, and clearly there are some challenges there. But taking half or a third or two-thirds or whatever it might be globally of the risk-free asset stock out of the system is clearly going to create frictions and issues in those markets. And it has done so. And if you look at swap spreads or you look at special repo rates, they got very, very wide during the period when we had intervened to the maximum amount. And that clearly is not helping the functioning. So QT is not always a contributor to market dysfunction. It clearly has a number of elements where it actually helps. I know the market says that QT is a major driver of the term premium, but if I may, and maybe this is a provocative comment, I've been surprised at how little the term premium has risen in the last year or two, not how much, particularly in the UK. It was, after all, a key objective of QE to push down. You did a lot of the work on it when you were at the Bank of England on the term premium, and that seemed to work quite effectively. You might well have thought, and let's get back to Petra's question a bit, I guess, as to how much this is genuinely a monetary tool, that you'd have seen a bigger reversal in the term premium, just because of QE switching to QT, let alone the extra issuance that you get from governments in the UK and increasing the US and elsewhere as well now. Maybe we are now seeing it in the US with this sharp run up in US yields. But even so, I think if I'd asked you or you'd asked me to draw freehand what I'd have thought of happening in the term premium as a massive QE switch to smaller scale QT, I'd have drawn a bigger pickup than has actually occurred. Disproportionately in the UK, as you know, the reason why our long spot rates have risen is because our short curve has risen. And the reason our short curve has risen is because inflation has been a major problem and people have expected, and we have had to, raise short rates quite substantially. So I definitely think that we are looking to re-energize market functioning with QT. It's one of the reasons why I personally believe that, for all the arguments against QT, we need to keep reminding people why it's also a good thing. But we need to be very sensitive and monitor closely the market functioning issues that you describe. Hopefully that answers the questions. There's your pen back, Claire. Thank you very much.
Thank you very much. And thank you very much to you, Andrew, for doing such a great job in providing us with a sense of the intellectual foundations of the central bank's balance sheet design, even though there's still a lot left in terms of where we go from here. I think you gave us some really excellent insights, and thanks a lot to all of you in the audience for some great questions too. I'm going to bring the session to a close now. We have half an hour for coffee, and then we'll meet back in here at 10:30 for the next session. Thanks a lot.
Thank you very much.
Really nice job.